Have you noticed how a single decision from the Federal Reserve changes your life? Without you even noticing, rates go up, your mortgage jumps, your car loan jumps, even your credit card bites harder. But who carries that decision all the way to your wallet? Banks, the hidden gears of the system. And here is the part almost nobody tells you. Banks lend out your deposit. Sounds crazy, but it's true. Loans create deposits. Had you heard that before? Does it feel counterintuitive? How does that work? Give me a minute. I'll show you in plain English. In a few minutes, you'll see the engine of the economy and know what to watch before the Fed's next squeeze. Has a rate hike ever blindsided your budget? 1. What a bank actually does think of a bank as money plumbing. It keeps cash flowing. Cards, checks, ACH, wires. It keeps your balance safe. But the most important job, lending. Ever thought about this? Money you can withdraw today gets turned into a 3-year mortgage. Has that ever shaped your home plans or your company's investment timing? Banks aren't heroes. They're risk managers. Before lending, they ask, will this borrower pay? Do I have cash for withdrawals and payments? What if rates rise and my securities drop? Did your bank offer you a higher yield CD right after the Fed hiked? Did your mortgage quote jump soon after? When the Fed raises rates, savers chase higher yields. Banks must pay more to keep deposits resolved. Mortgage, auto, and credit card rates go up. Have you felt that hit within the same month of a Fed announcement? 2. Loans create deposits. The simple proof, here's the point. You take a $100,000 loan inside the bank. 2 lines appear at the same time. Asset, a loan. Liability, a deposit in your account. Done. A deposit is born. It didn't come from your neighbor's money. It didn't vanish from someone else's account. Did you know the deposit is created the moment the loan is made? Does that change how you see banks as vaults? What about reserves at the Fed? They call me after interbank plumbing and daily settlement. There are breaks. Capital, liquidity, risk, not a free-for-all. Can you picture those 2 lines popping up together? Does that make it click? 3. From the Fed to your wallet, the Fed moves the federal funds rate. That shifts banks' funding costs. Higher funding costs gives more expensive loans. More expensive loans gives fewer purchases and investments. Less demand inflation cools with a lag. Have you seen your credit card APR jump month to month? Ever had a loan pre-approval become unaffordable after a rate move? Where you feel it first? 30-year mortgages, auto financing. Credit cards, businesses feel it in working capital. Housing and durables react early. Jobs react later. Have you noticed that lag rates up now? Labor market cools months later. 2 quick signals you can check today. Yield curve inversion, short greater than long. Do you watch that? Mortgage spread versus 10-year treasury. If it widens a lot, fear's in the air. Have you ever tracked that spread? 4. Where things break and why you should care. Crises come from 2 monsters. Liquidity and solvency. Liquidity. Everyone wants cash now. Solvency. Assets aren't worth what the books say. When both hit together, bank run. 2008. Weak mortgages got packaged into securities. Defaults spiked. Markets cracked. 2023. Rates surged. Long bonds lost value. Uninsured deposits ran via mobile apps. Did that touch your bank or someone you know? We have stress tests, capital buffers, FEDIC coverage. But without solvency, liquidity alone won't save the day. When banks slam the brakes on credit, the economy have you seen hiring freeze or projects shelved because financing got pricey? 5. The dashboard I watch, and you can too. Want a feel for the wind direction? Watch these 5. Yield curve 10Y to Y persistent inversion equals warning. Do you check it? Fed's Senior Loan Officer Survey or banks tightening. Have you read it before? Credit growth in H8R. Bank balance sheet loans expanding or shrinking. Did you know this comes weekly? Delinquencies, mortgages, autos, cards, corporates. Has any hit your circle lately? Mortgage spread versus 10-year treasury. Wider equals fear, tighter equals confidence. Do you watch when that spread blows out? This dashboard reveals the chain. Fed Bank's credit economy. Does seeing the chain help you watch the movie before the ending? Banks are the transmission belt from the Fed to you, the economy's oxygen valve. When they open, the country breathes. When they close, the country gasps. The myth is gone. Loans create deposits. But the brakes are real. Capital, liquidity, risk. Which piece has hit you most? Mortgage, auto, or credit card? What would you change in your plan if credit tightens over the next 90 days? Will you start tracking these 5 indicators this week? Want to read the next quarter early? Watch credit. If banks open the spigot, activity picks up. If they tighten, get ready for headwinds. Truth is, to understand banks is to understand the business cycle. And now you've got the map. Did this change how you see the system? If this helps, like, subscribe, and hit the bell. It helps the channel a ton. Drop a comment. Do you want a quick explicable with animated T accounts or hands-on guide to those 5 recession signals? Which one would you actually use next week?